Now, finally, when making an Everett assignment, now the FC10 Everett was the case of a husband who was a solicitor assigning future income to his wife, who was also a solicitor, and the court said that that is actually something that you can do, subject to some limitations. However, there's a couple of difficulties here. The first of which is that you're assigning to minors. Now, when income is going to minors, again, the same rules that we had earlier with the punitive tax rates are still going to apply. So that, sure, you can assign the income stream to the children, but they're not really going to benefit from it because everything they earn above sort of $1,400 odd is going to be subject to a 45% marginal rate. So there's really not a lot of advantage to that. However, there could be some advantage of instead assigning it to a company. The reason for that is that the company has a tax rate of 30%. So that if they had a company as beneficiary, which is perfectly valid as a structure, then it's going to have a top tax rate of only 30%. So that it may actually be beneficial to do that. Plus, you also have the flexibility of companies being able to impute distributions. In other words, through the franking credit system, to be able to pass those on to the shareholders. Now, finally, if they actually assign their actual partnership interest itself, in other words, the tree rather than the fruit, then CGT is going to apply. And so the market value substitution rule will kick in because they're disposing that for a value which is not equivalent to an arm's length transaction. And you've also got a couple of other problems because the cost base might be really, really small. So that if they originally contributed very, very little capital into this business, built it up over a long time, they and they particularly if they financed it with loans, deducted that interest over a long period of time, they're going to end up with a very large CGT liability because the cost base itself is going to be really small. And so that's something that you would need to take into account to just have a think about when answering this style of partnership problem. In this recording, we're going to be looking at partnerships and how to go about taxing people who are in partnerships. Now, this particular problem scenario that we're looking at here is quite long. It's the sort of thing one would expect to be in, say a 10% or 10 mark exam question. And it takes a little bit of reading, and I suggest that you do step through each individual component. But in the broad sense, this is a partnership between three people who have contributed uneven or different amounts of capital, and their agreement, the contractual arrangement they have between them, gives them an entitlement proportional to that capital contribution they have. We also have a system for drawings here, and the partners can also draw with consent of other partners additional amounts as debits from their current accounts. And there's an interest component too if a partner draws more than what their current account is at the end of the year. There is also another difficulty with this problem in that one of the partners is non-resident. And so they've gone to open a branch office in Singapore, and another partner has agreed to loan some money to the partnership with a payment of interest of 10% per annum. So here we're going to calculate the net income of the partnership, and to do that we're going to have to examine the deductibility of this loan. And then after we've calculated that, we're going to determine the net income for each of the partners. And as a part of that, we're going to have to look at some residency aspects of that as well. So the first thing to note about partnerships is that while they're not legal entities, for taxation purposes, we treat them as an entity, or at least for the first step of trying to determine what the taxable income figures are for each partner. And so not only are partnerships, treated as taxation entities, they're they're required to furnish tax returns, even though individual partners are the ones that eventually pay tax on their assessable income. Now, again, we start with this basic premise that Australian residents pay tax on all income, whether derived in Australia or elsewhere, whereas non-residents only pay tax, Australian tax, on income that's sourced from Australia. So in this particular problem scenario, we've got a firm with $800,000 worldwide, whereas 600,000 of that is from Australia, 200,000 offshore from Singapore. Now, there's a few things to note here, and one of the most important, I guess, principles of partnership taxation is this idea that arrangements between partners, in terms of moving money around, and some partners having drawings and other partners charging interest on amounts that are outstanding and such like, these sorts of arrangements are not actually income or expenses. They're actually just internal reallocation of profits or future profits between the partners. And it's a really important concept, this idea of what's called the mutuality principle, that essentially partnership and partners dealing with each other don't cause any taxation events to arise. And there's some exceptions to that, but in the case in this scenario of interest from excess drawings as part of the partnership arrangements is not going to form part or be included in any of the income calculations. That's going to arise later on when the firm's trying to determine how their income is to be distributed. So here, the deductions that we're given is we've got 250,000 attributable to Townsville and 100,000 from Singapore. Now, when looking at the interest on the loan, we have to determine whether or not this particular loan is one of these arrangements that's just between partners, or whether it's a genuine arm's length transaction. You see, partners can loan money. There's not a hard, fast blanket rule that they can't loan money to partners, the partnership itself, but it has to really be characterized as a bona fide loan. It has to not be essentially a capital contribution. And so in this situation where we've got a genuine arm's length loan with a genuine sort of market rate of interest, that can be considered to be an arm's length transaction and not an internal transaction between the partners. And as such, you can get an 8-1 deduction as a result. And so here, as mentioned, the interest on each partner's capital contributions is just a reallocation of profit shares. So the net income is going to be $800,000, the gross income less the stated expenses in the problem, question at $350,000, less the $25,000 interest on this loan, so $425,000. So when we're calculating the net income for each partner, it's usually best to start with the easiest one. So, for example, Z, the easiest one here is Z is a resident, has earned assessable income here of the appropriate fraction of his share, based on the capital contributions, which was in their partnership arrangement. And that comes out at $90,250. The X is also a resident and has, again, an amount that's calculated according to the fraction, which was the original capital contribution. And so his fraction is going to be $150,800, but also in this situation, he's also deriving $25,000 interest from the loan. And if you get a problem scenario like this, you need to take that into account. Finally, Y is a non-resident. Now, if a question like this arises, you really have to go through and talk about the residency rules that we discussed in this subject in the first week. And Section 6, subsection 1, under the definition of resident in the 1936 Taxation Act, has these 4 tests. If any one of them are true, you're deemed to be Australian resident. The superannuation test, the 183-day rule test, the common law test, and also the domicile test. Now here you would, I guess most appropriately, where a person has actively been away for the entire year. The question here is that even though the person eventually intends to return to Australia, the permanent place of abode is still elsewhere. And again, that's Jenkins and Applegate's. The idea of the courts in that situation said, look, permanent doesn't really mean forever. It really means a long-standing, lasting time away from the country, Australia in this case. Now, because of this person's share, which again is the percentage of capital they originally contributed, which is 183,950. Because it's not all sourced in Australia, we have to work this out as a fraction. And so to do that, we just work out what the fraction of the income that's this particular firm has derived in Australia and hasn't derived in Australia. And so here, we just look at the net income of the partnership, which is sourced in Australia, so the Australian income less the Australian expenses, and then we just work this out as a fraction of what all of the income is for this partnership is in entirety. So here it's really 350,000 divided by 425,000. That's the percentage of taxable income that this firm has derived from Australia. It's quite a simple calculation. And so here, that's simply multiplied against partner-wise taxable income. And the result is 151,488. In the next part of this recording, we're going to look at partnership strategy. In other words, steps that partners or people in a business that is operating partnership, things they can take in order to minimize their tax liability. And so here we have a husband and wife type arrangement where they have been running a trucking business for a long time, for almost 30 years. And it has a warehouse, leases 3 trucks, and is quite profitable. They've also got 3 children. And so the question here asks us not just to think about rearranging partnerships in the general sense, but also the specific implications that that has when income is applied to children. And here there is also an existing discretionary trust. And we'll talk about trusts later on in the subject, but it's important here to look at both the income aspects and the capital gains tax implications of adding these children in as partners, or assigning the income streams to the children as well. So when we're looking at adding children as partners in a business partnership, the taxation problems that can come from that, we really should split this into 2 parts. First of all, the act of adding or removing a partner, as you're probably aware, actually dissolves the partnership. Accounts have to be taken, and a new partnership continues from that point moving forward. Now, with children, there are some difficulties, as you could probably imagine. The first of those is that for a long, long time, the federal government's been very aware that using children, which I would hazard that a lot of people in business have, as a mechanism to income split, would be a very powerful tool for most people to be able to achieve in those sort of situations. So as a result, there are some quite stringent rules in terms of children and them deriving income. So basically, there is a punitive rate, so that for every $1 a child earns above $416, that doesn't come from them sort of working as an employee and so on, it is actually taxed at 66 cents to the dollar, up to a maximum of $678. And then there's what's called a shade-out period, and for every dollar earned above $1,446, then they're taxed at the top rate of the 45 cents to the dollar. Now, there are a host of exemptions here. The most common being that a minor is exempted if they're engaged in full-time occupation. In other words, they're actually working full-time, and that kind of makes sense. So here, there's some things to note with this particular problem. First thing is that the income split, or the advice that we're sort of giving to the partners here, is coming in the last 2 months of the tax year. And one thing about partnerships and dissolving partnerships is that it occurs at the date at which it actually occurs. And that's question of fact. You can't elect to backdate or to forward date the dissolution of partnerships. And so here, the income splitting difficulty we have is that you're only going to be able to do it for 2 months, because the old partnership is going to cease, and then you're going to start a new one. So you need to take that into account. And that putting the younger children in the scenario into the partnership is going to be a bit of a problem. Remember, we have 3 children, one of whom is 18, is no longer a minor. The other 2 are still minors. One of whom is interested in actually being part of the business. And so in terms of the strategy here, the part of the advice you can give is that, look, this person can be employed, provided they're employed on the last day. So that can actually be something to present as a strategy to a person who's seeking advice from you. Now, another aspect comes to this is what's called the uncontrolled partnership income. And again, there is a penalty rate in Section 94 of the old Tax Act. And that's when a person is being applied income, but they have no real effective control over the affairs of the partnership itself. And again, this is an anti-avoidance measure that's been put in place for a long, long time to prevent people from, particularly where, and again, without sort of delving into too much gendered language, where you have a husband and wife partnership, where one of the 2 essentially derives most of the income from the trade, and the other person doesn't have much income at all. Again, that would be a classically straightforward way of splitting income. And in those situations, the passive partner, has to actually be a partner. That's really what this thing's about. In order to gain the tax benefits of being in a business partnership, you actually have to operate as a partner. You can't just be receiving passive income. And so here, the 18-year-old that the 2 parents were contemplating putting into the partnership would have to be more than a mere spectator. She would have to actively be involved in the business and not be wholly under the, I guess, the dominion of the parents. That she wouldn't necessarily just follow exactly what they said. And because if she does just sit passively in the partnership, this 47% marginal rate will apply. And thus, it's really not a good mechanism for income splitting. So the next thing to look at is the capital gains tax implication. And this can be problematic when a person is added to a partnership or leaves a partnership, as we're aware, it dissolves. But also when a person contributes assets into the partnership, that has capital gains tax implications. And the idea is that, look, if there is an existing partnership and of X number of people, and one of those partners puts an asset into the partnership, the partnership is gaining an asset, great. But the person who's putting the asset in, who's disposing of it, again, that triggers a CGT event, but it's only a partial disposal. And the reason for that is that, sure, you've got an asset, you put it in the partnership, but a fraction of that partnership is yours anyway. You don't trigger a CGT event when you transfer things to yourself. It just doesn't make sense. And so this is taken into account under the CGT regime. And so when an asset is put into a partnership, each partner is essentially considered to have acquired a fractional interest in that asset. And in situations where there's either no money considerations offered, or it's something that's either much below or much above market value, it's not an arm's length transaction, and the market value substitution rule applies. That's a rule established in Section 116-30 that just says, look, if either of those situations apply, an asset's being transferred that would be subject to CGT, either no consideration or something that would be much higher or much lower than what it is, the actual CGT implications are as if that asset was transferred at market value. Now, another thing that you need to account for when adding or removing people into partnership and assigning partnership interest to people is this idea of goodwill. Now, a goodwill is a little bit tricky in that it actually has a slightly different definition for those that are familiar with the accounting idea. That in accounting is that idea of the extra, I guess, value that a business has that's been trading for a long time, that people see and associate, and often this is intermingled with things like brands. And in a simpler sense, when you sell a business as an arm's length transaction, in other words, not to a related party, the goodwill is simply the amount of money in excess of what all of the assets and taking into account the profitability of the business, the excess that you're paying, the premium that you would pay. And in terms of taxation law, the valuation in terms of CGT pretty much defers to the accounting standards. So that when an asset, a partnership, I should say, is transferred, or an interest is transferred, that can simply be valued. Forensic accountants come in, do a valuation of that particular business, and again take into account profitability, and so on, to determine what their goodwill is, and that is an asset that is transferred, and it's subject to CGT as well. And so here, where we have a business that has this warehouse, it's going to have goodwill, and it's got these leased vehicles. We've got a few problems and some ideas in terms of strategically doing those. So the first thing to note is that the goodwill is going to be large. It's going to be unlikely, assuming you've got accountants to come in, they're not going to give some value to that, particularly as the business itself is profitable. Also, the warehouse, although it's not stated in the problem when they purchase that, may have increased in value, and that may also be subject to CGT when the partnership is dissolved and the additional partners being let in. And so it may be a situation here that when adding a partner in and the partnership is dissolved, that it may be appropriate for the two owners to just keep the warehouse itself. So they just keep that. Again, it's not stated here whether they own it, whether it's in the partnership name, whether they have it as a common or joint tenancy. But it's something that they could have, and then just simply let the business use that, assuming that that's structured in the partnership agreement when the new partners come in. Typically arises with the trucks, of course. You can't do that, largely because from the purpose of the people names on the lease, they wouldn't be deriving income from that. They wouldn't be part of their business. And so as a result, they wouldn't be able to get an 8-1 deduction. And so here, something to note is that if there are leased items or assets, those in that situation, you can't just let the business use them. You'd actually have to go and change the lease over to usually to the name of the new partnership.